Hey everyone, Mike DeBlis here. Welcome back to the webinar on Demystifying the FBAR. We're now up to Module 3. This is where I answer some of the most commonly asked questions clients ask me about the FBAR. What better place to start than on what is the date of an FBAR violation? Contrary to popular belief, it's not December 31st of the year that the account is being reported. Instead, an FBAR is due on June 30th of the year following the calendar year that the account is being reported. This is the last possible day for filing the FBAR. So the close of June 30th with no filed FBAR represents the first time that a violation has occurred. Here is a quick and dirty example. Let's suppose that John opened up a Swiss bank account on October 1st, 2014. In that case, he'd have until June 30th of 2015 to report that account on an FBAR. How far back in time can the IRS go to assert an FBAR penalty? The statute of limitations for asserting an FBAR penalty is 6 years from the date of the violation. Now, today is May 1st, 2015, so the farthest back in time that the IRS can go to assert an FBAR penalty is 2008. In the spirit of being totally forthcoming with you, I have to be honest that I didn't just pull this out of thin air. I had to put pen to paper and go back in time to do some math in order to arrive at 2008 as being the year that is still open for FBAR penalty assessment. But you can see a little bit of my logic in the second bullet point. The due date for 2008 FBAR was June 30th, 2009. So that was my starting point. I went back and I started testing the years, and I might have even gone back to 2007 first, but in any event, I analyzed 2008 and determined that with the 6 year, or determined that with the violation rule, that a violation for failing to report a foreign account in 2008 would have occurred after June 30th, 2009. In other words, the taxpayer had up until June 30th, 2009 to report his or her foreign bank account without any penalties. From there, I added 6 years to June 30th, 2009. That brought me to June 30th, 2015. That's the 6-year anniversary. And bingo, I realized that as of today, May 1st, 2015, the IRS still has 2 more months to assert an FBAR penalty for tax year 2008. So through this extrapolation, I was able to determine that the statute of limitations period for assessing a 2008 FBAR penalty was still open. Of course, the remaining tax years are also fair game for FBAR penalties, those being years 2009, 10, 11, 12, and 13. Here's a question that I get asked all the time. Does the fact that my foreign account generated no interest income or negligible interest income rise to the level of a defense if I failed to report it on an FBAR? Well, the IRS company line is this. It has said time and time again that no amount of unreported income is considered, quote, de minimis for purposes of determining whether there has been tax noncompliance with respect to a foreign account or a foreign asset. So what this tells us very directly is that even if the interest income generated by the foreign bank account was 50 cents the IRS will view that um, in the same light, as an interest, as a failure to report $50,000 of interest that was generated by a foreign account. Um, and that is what their company line is. Now, in theory, what we as tax attorneys in the international compliance field see routinely is the IRS scrutinizing the high watermark balances of the taxpayer's foreign account, more so than the interest income generated by the account. Why? Well, for the simple reason that FBAR penalties are calculated based on the high watermark balance of the account, and not based on the interest that was generated by the account. As we all know, a six-figure bank account does not, at the end of the day, generate a whole lot of interest income. And if it does, it's usually offset by the foreign tax credit. In other words, to the extent that the taxpayer has reported the interest generated by the foreign account to the foreign taxing authority and has paid foreign taxes to the foreign government, the foreign tax credit might wipe out any U.S. tax liability that he or she has based on the interest income generated. So again, it's the high watermark balance that oftentimes gets the IRS's attention, and and is something that they really go OCD on. I should say that when I'm talking about high watermark balances, typically any amount from mid six figures to high six figures will draw intense scrutiny. But not to get too off track with with the question I'm addressing here. This question relates specifically to the interest income. And again, going back to what I said earlier, in the IRS's mind, it doesn't matter whether the interest generated by the foreign account was 50 cents during the tax year or $50,000 during the tax year. They claim that they're going to view it the same, and that if it hasn't been, if the interest hasn't been reported on a 1040 and the foreign bank account hasn't been reported on an FBAR, then they view that as tax non-compliance. No questions asked. They're very rigid in that respect. So while we sometimes like to become absorbed in what amount of interest was generated and what taxes would otherwise have been owed, if any, to the U.S. government after considering the foreign tax credit, all of that is meaningless for purposes of how the IRS views tax noncompliance. What are the penalties for failing to file an FBAR? Well, contrary to popular belief, an FBAR violation doesn't automatically mean that a penalty will be asserted. Examiners are expected to exercise their discretion when determining whether to assert a penalty. In doing so, they must consider the facts and circumstances of each case. For example, the examiner may decide that the facts do not warrant asserting a penalty. In that case, the examiner would issue an FBAR warning letter, otherwise known as Letter 3800. Now, I caution you here to tread very carefully, because while this has been explicitly stated by the IRS in various publications that they have published, it's always important to understand the climate that we live in. And as many taxpayers with foreign bank accounts understand, the focus of the IRS today is on foreign bank accounts. It is the catch of the day. The IRS feels that it has been very generous in expanding the streamlined procedures to a wider base of U.S. taxpayers. And so when we read this, this guidance that an FBAR violation doesn't automatically mean that a penalty will be asserted, we have to read it in the context of the environment that we live in today. And that is, and that's very important to understand. Now, to the extent that the examiner determines that an FBAR penalty is warranted, there are two types. The first is non-willful, and the second is willful. Both types, willful and non-willful, have varying upper limits, but no floor. For the non-willful FBAR penalty, the maximum penalty that can be asserted is $10,000. Now, before we go any further, I want to be very clear. When I say the maximum penalty that can be asserted is $10,000, I'm not referring to per year. I'm referring to per account. So very simply, if the taxpayer has multiple foreign bank accounts in a given tax year, and the IRS determines that the non-willful maximum FBAR penalty applies to all of the taxpayer's unreported accounts for that year, then they can begin to aggregate that maximum FBAR penalty up potentially aggregating it until it goes out into the stratosphere, because what we have here is if in this example there are multiple bank accounts and the IRS determines that the non-willful FBAR penalty is warranted, then they would essentially assert that penalty for each account. And as I said, that means that the liability would increase exponentially. So the fact that all of those accounts would have been reported on one FBAR doesn't mean that the maximum non-willful FBAR penalty is $10,000 for everything just because the FBAR wasn't filed. It instead means that the $10,000 penalty is asserted per account. And if there were 3 foreign bank accounts that were unreported, and the IRS determines that the maximum non-willful FBAR penalty applies to each account, then the taxpayer faces a $30,000 non-willful FBAR penalty. The maximum willful FBAR penalty is the greater of $100,000 or 50% of the closing balance in the foreign account as of the last day for filing the FBAR. Just like the non-willful FBAR penalty, the willful FBAR penalty is assessed per account, not per year. So again, if the taxpayer has 3 unreported accounts in a specific tax year and the IRS determines that the willful FBAR penalty is warranted, then essentially those willful FBAR penalties would be aggregated one on top of the other, and potentially increasing the taxpayer's liability into the stratosphere. I've heard of something called the penalty mitigation guidelines. What are they? Well, because FBAR penalties have no set amount, the IRS has developed penalty mitigation guidelines to assist examiners in exercising their discretion in applying these penalties. Now, the mitigation guidelines apply to both non-willful and willful FBAR penalty amounts. Under the guidelines, the penalty amount is tied to a fixed, predetermined maximum aggregate balance for all accounts to which the violations relate. Remember that we talked briefly before about how the maximum aggregate balance is of particular interest to the IRS. That, again, is because FBAR penalties are based on the maximum aggregate balance of the account and not on the interest that was generated by that account. Here's an example. Under the non-willful penalty mitigation guidelines, if the maximum aggregate balance for all accounts to which the violations relate did not exceed $50,000, meaning was $50,000 or below at any time during the year, a level 1 non-willful penalty applies. The corresponding penalty is $500 for each violation, not to exceed a total of $5,000 in penalties. So the IRS has published a chart that goes into detail for all the levels that apply. For non-willful, there are 3 levels, and for willful violations, there are 4 levels. But this was merely an example to illustrate how the guidelines work and how the penalty amount is tied to this fixed, it's tied to a fixed predetermined maximum aggregate balance for all accounts. It gets quite complicated, but once you go through a few examples, it gets a lot easier. Well, the next logical question is, since we've discussed the penalty mitigation guidelines, how do I know if I qualify for them? Well, a taxpayer qualifies for the penalty mitigation guidelines if he satisfies the following conditions. And I should probably preface this by telling you that the vast majority of taxpayers do qualify for the penalty mitigation guidelines, and you might realize right away why. The first condition is that the person has no history of criminal tax or Bank Secrecy Act convictions for the last 10 years and has no history of prior FBAR penalty assessments. Second, no money is passing through any of the foreign accounts that is associated with the person, can be from an illegal source or used to further a criminal purpose. The third condition is that the person cooperated during the examination. And 4, the IRS did not assert a fraud penalty against the person for an underpayment of income tax for the year in question due to the failure to report income related to a foreign account. So the threshold conditions are usually easy to satisfy, yet it is still very important to to check them off and make sure that each one is met. Are FBAR penalties determined per account or per unfiled FBAR? Well, we've discussed this issue already. I don't want to beat it to death, but just to give you a quick and dirty outline here. First, FBAR penalties are determined per account, not per unfiled FBAR. That's significant because one FBAR base, if you have multiple foreign accounts, you have to list all of them on one single FBAR. That's what leads taxpayers to believe that that the FBAR penalty is based on merely an unfiled FBAR. So if there was a non-willful FBAR penalty asserted, that it would be $10,000, and it was determined to be the max. That the worst FBAR penalty the taxpayer is facing is $10,000. Not so if there are multiple foreign accounts, even though all the foreign accounts are listed on one FBAR. Second, penalties apply for each year of each violation. So, a taxpayer who fails to report 5 foreign bank accounts in a single tax year is subject to 5 separate FBAR penalties for that year alone. Taken together, this means that FBAR penalties can be aggregated, one on top of the other, catapulting the taxpayer's civil liability into the penalty stratosphere. I'm sure that that's not something that people like to hear. I know it's something that people don't like to hear, but it's important to know that right out of the gate, since this could potentially be the result if the taxpayer decides to do what's called a quiet disclosure and merely file delinquent FBARs and amended 1040s for the years in question. So there is a real risk that the FBAR penalties can catapult the taxpayer's liability into the stratosphere. And that is the risk, of course, that must be taken into consideration whenever a taxpayer is determining the best course of action for coming into compliance. As always, if you have any questions, I encourage you to give me a call or send me an email. I'm more than happy to get back to you and answer any questions that you might have. Understand that the information that I've provided today is very general information and has not been customized to the individual facts of your case. So that's a long way of saying that you can't rely on the advice that I'm giving you in choosing between what method of disclosure is best for you. Please do consult a tax attorney at all times, since in today's environment, this is a heavily scrutinized and has very small margin for error. So I look forward to seeing you in Module 4.